Clay McDaniel, Chief Investment Officer of Waverly Advisors. I'm here to talk about sort of the quarter that just ended and where we're at and what we think about the market going forward. The year started, pretty weak for markets, especially for technology and U.S. Markets, which are overweight many of the leaders in AI and technology. There was a lot of skepticism around the future of AI, particularly around software companies. All that changed in March. The Iran conflict was a shock to the market, particularly non-U.S. markets. A lot of uncertainty on how bad it would escalate, how far the U.S. would go, how far Israel would go, then how far Iran would go in response. As that worst case scenario seemed to come off the table, the risk of escalation died down and markets went back to fundamentals. What you've seen since then is two things. One, on the technology side, continued advances in AI, driven by Anthropic primarily in the Mythos model, combined with an extraordinary amount of demand from businesses in the United States and globally, has fueled a rapid comeback in that part of the market. Interestingly, even though performance has come back, earnings expectations have risen so much that valuations are actually cheaper than where they started this year. On the other hand, when you look outside the United States, you had a period where non-U.S. markets, international markets, which tend to be heavier in banks and financials, tend to be more cyclically focused, tied to the economy. They had been outperforming. They're far more exposed to a continuation of the Iran hostilities. So you've seen more weakness in those markets, sort of a return to U.S. outperformance we saw a couple of years ago. What it underlies to us is really sort of you want to own both. We've had a lot of back and forth over the last few years. One market outperforms, one market underperforms, and it goes back and forth. Having quality across both those markets and rebalancing has been important. Big picture, the thesis is pretty similar to what we've talked about in prior quarters and written about in our letters. We're in a different environment, a different economic regime than we were in the post-Great Financial Crisis period. That period had underinvestment, period had higher unemployment, low inflation. What we're seeing now is high investment in AI and power generation and infrastructure and defense spending, elevated geopolitical risk. A lot of that spending is being financed by governments around the world, and you're seeing higher budget deficits. You're seeing higher trend inflation. Is it better? Is it worse? Yes. There's parts of it that I would prefer the old environment. There's parts of it I would prefer the new environment. It doesn't matter what I prefer. We're investing in this environment. And so we take reality on reality's terms. What it means for portfolios, the traditional diversification, just owning stocks and bonds, not as much of a reliable buffer from bond markets as we had before. So what do? There's alternative strategies. There's private markets. We've built out a toolkit, we think, for every client in every setting. It takes time. It takes education. We want to be very specific about where we invest and where we get diversification. But a lot of what you can get from those markets, not only is it return potential, but it's true diversification, and it's also protection against certain environments like elevated inflation that is really hard to find in public markets. And so for all of those reasons, we want to use the full toolkit. We've got a great team. I'm very proud of the team we've built and the level of expertise we have across the platform, and we would love to spend more time with you and talk about it.